Welcome to the NWR Communications Near-Term Producers Conference. Today, talking to Keith Bowers. He's the Managing Director of Lotus Resources. They have the Kayelekera Uranium Project over there in Malawi. Recently announced a resources update. Here to give us another update is Keith. Keith, over to you to tell us what's going on with Lotus. Great time to be in uranium.
It is a fantastic time, and thanks very much, Kerry. So as Kerry's mentioned, my name is Keith Bowers, and I'm the Managing Director of Lotus Resources. Lotus Resources owns the Kayelekera project, which is a past producing uranium asset located in Malawi in Central Africa. We're an ASX listed company, but last year we also had a look at trying to improve on our US investor base as well. So we also have an OTC QB listing as well at the same time. So I'll just quickly jump through the presentation, Karen. If you've got any questions you want to ask me as we go through it, I'm more than happy to take any questions.
Keith, before you even go into the first bit of the presentation, that is a fantastic picture that I am assuming is showing the project itself. Because it's
correct. So that was a picture that was taken by the previous owners towards the end of when it was operating. So it operated from 2009 to 2014 and was shut down then and put into care and maintenance effectively because of the low uranium price at that time, which made it unprofitable for it to continue operations. But yes, that's a picture of our site that was taken probably late 2014 or early 2015, I think. So you can see a very, very well-established, very, very well built and very well constructed site out there that all we need to do is spend a bit of money on refurbishing the plant and we can start back up again.
Now, when they put it in care and maintenance, Keith, what was the uranium price? Because today it's getting stronger.
Correct. So when they shut it down, the way that Paladin, who were the previous owners of the asset, had it or were operating it, they had a significant portion of their production going into the uranium spot market. And the spot market in late 2013, early 2014 had dropped down as low as $35 per pound. And this was really on the back of Fukushima happening earlier on. Their operating costs, when you go through their annual reports and that, and you have a look at what Kayelekera's cash costs or operating costs were, they were around that $35 per pound as well. So they weren't actually making any money at that point in time, and hence the reason for them shutting down, with, I believe, the intention that they would be able to start up relatively quickly when the uranium price recovered. But of course, as we all know, it's been a very, very slow recovery in the uranium price. And it's really only been in the last 18 months or 2 years that we've actually seen a significant increase up to today's price of around $59 per pound. So if they were operating today, it would have been a very, very profitable operation.
Okay, thanks, Keith.
So just my normal important notice regarding forward-looking statements that I'm going to make during the presentation. But really, so to jump into the presentation itself, as I mentioned previously, Kayelekera is a proven uranium producer. So as I said, it operated between 2009 and 2014. And in that period, it produced about 11 million pounds of uranium, all of which was accepted by the Western facilities, Western conversion facilities, or the Western utilities. So that means Orano in Europe, it means Cameco in Canada, and it means the Converdyne conversion facility in the US as well. So it's a well-known product out in the industry at the moment. And we know from our conversations with various utilities and various conversion facilities that they understand the product, they're comfortable with treating the product. So we see that as a real opportunity for us when we go into our marketing exercises. I think it's also really important to note that when Paladin built that plant, and as you could see from the picture we had on the first slide of the presentation there, spent around $200 million on the asset. So that was with the process plant, the accommodation camp, the tailings dam, access roads, and all the other infrastructure that you would normally expect to see with a mining project. So what does that mean for us? Well, we have no intention of increasing the throughput rate of the asset when we bring it back online again. So it is currently capable of producing around 3 million pounds per annum of production. That's what it achieved when it was operating previously, and we have no intention of increasing that. So any capital that we need to spend on the project is effectively on refurbishing the plant. So there's some things we need to do around the mills, around the tanks, around some of the foundations we need to fix up, some of the electrical gear, because obviously the plant has been sitting there for about 7 or 8 years at the moment. So we need to spend some money on that. And based on our initial scoping study that we announced to the market in 2020, we think that's about $50 million is required to be able to refurbish the plant. We've also, and I'll talk about this a little bit more as well, but we've identified a number of new technologies out there that were not available back in 2014 that we think can really help drop that operating cost as well. So as I mentioned, Paladin was operating at $35 per pound. We think that with the new technologies that I'll talk about a bit later, we can significantly reduce that operating cost and hopefully bring it down to below $30 per pound, which I think would put us in a really good position in terms of moving forward. Maybe just one other thing to touch on as well. There is still some significant exploration upside to the project. So Kerry, as you mentioned at the beginning over there, we've recently announced a new update to our resource. So when we acquired the project of Paladin, we had around 27 million pounds in our mineral resource estimate. That has now grown to 46.3 million pounds at around 500 ppm grade as well. So we've been able to grow significantly, and all that growth is within the existing Kayelekera resource. So we've been able to extend it in terms of some step out drilling that was very, very successful with it. We reviewed some historical data as well and identified another lode lower down in the pit as well, so we can drop our pit down further to get more material. And also when we start to talk about our technologies, we've had a look at our economic cutoff grades as well, which has also had an impact on it. So 46.3 million pounds of uranium at the moment. Based on our current schedules, we're looking at about a 10 to 12 year life of mine. We think that'll come out of our feasibility study. We're also investigating or doing some exploring at the moment in a new tenement package that we acquired late last year, an area called Livingstonia, which is about 90 kilometers to the south of Kayelekera. We've got the drill rigs turning there at the moment. A number of samples have been sent off for assaying. We're just waiting for the final bits of those to come together before we're able to announce those to the market. I just want to quickly talk about why we think that the Kayelekera asset is such an important asset when you look at the global supply chain. So one of the things you want to have a look at, I think, when you're looking at the markets is that when you recognize or when you have a look at the historical uranium prices, it does come up in peaks and then drop off relatively quickly. We obviously had the huge peak that everyone's aware of back in 2007, where the price got as high as $137 per pound. But that dropped off partly due to the GFC, and of course Fukushima also had an impact on that. There have been a number of other smaller spikes since then, but generally they do happen quite quickly, and there's maybe a 1 or 2 year gap between the various ones coming through. We're of the opinion, and I think the pricing is proving it, that we're at the start of a new super cycle at the moment. As I said, we've gone from around $44 at the beginning of this year, and we're sitting at $60 or almost $60 today. So we do believe we're at the start of a new cycle of high pricing coming through. And then when you make that assumption, you then stand back and say, well, what are the companies that are most likely to be able to benefit from this new super cycle that's starting? And in our opinion, it's the companies that have assets on care and maintenance. And the reason why I say that is because they are the ones that can come online the quickest. If you have a greenfield project, you still need to go through all the permitting exercises. You need to construct it, you need to commission, and you need to ramp it up. And that could be a 5 to 10 year period associated with it. An asset on care and maintenance, where in our example, you just need to do some refurbishment and bring it back online again, we're talking 18 months to 2 year periods to be able to bring that asset back online again. So we think those are the companies that are most benefit from the start of this new super cycle with the uranium price. And when you look around the globe, what are the companies that currently have assets on care and maintenance? And if we ignore the state-owned enterprises, such as the ones in Kazakhstan, and just focus on publicly listed companies, there's obviously Cameco, and they've recently announced the restart of MacArthur River, but they also have Rabbit Lake, Smith Ranch, and Crowbutt up there as well. Paladin with their Langer Heinrich asset is another one. Ourselves with Kayelekera, then you've got Energy Fuels, you've got Nichols Ranch and Alta Mesa, and Boston Peninsula as well are the other two companies out there at the moment. So when you have a look at Kayelekera, Kayelekera is actually the third largest production or producing asset currently on care and maintenance. Only MacArthur River, Rabbit Lake, and Langer Heinrich are larger than Kayelekera. So we're the fourth largest asset currently sitting on care and maintenance. And when you look at our market capitalization, using that as a criteria against our peers, we think we're actually still very low value. we still think there's a significant increase in our share price potential moving forward. And I think what's happened is we need to get the story out there. I don't think people recognize just what a significant asset Kayelekera is and what a large producer it is within, within the global supply chain. So I think it's really important that we get this message out there and people understand just how good the Kayelekera project is.
Well, it's really good slide, that one, because to me, it looks like there's a complete disconnect between some of those other projects, as you said. But I'd also like to just say that where you say commercial production not achieved with Boston Peninsula, what do you mean by that?
So what I'm saying about is they are assets that are on care and maintenance and they have operated previously, but they were unable to reach or didn't reach their nameplate capacity prior to the shutting down. So their costs were pretty high because obviously they didn't reach their production rates. So they've started, they've operated, and they've also been shut down. But during that operating phase, which in some cases was a relatively short period, they did not achieve their nameplate capacity or reach commercial production, as we would reference it. So there's still some work that they need to do around those assets as well.
Okay, well, it's a very clear slide. Thanks, Keith. It's really interesting.
So I'll just talk a little bit about the nuclear industry as well, and nuclear space and marketing and all that kind of stuff, why we think we're at the start of a new super cycle and all this kind of stuff. I don't have a specific slide here on Russia and Ukraine and the influence that has, but I will talk about that a little bit as well. But I think if you try and look at the long-term fundamentals out there, what is it that's driving the uranium space at the moment? And the way we look at it is we look at it from three different perspectives. We look at it from the EU perspective. So we all know there's been conversations happening in the EU for the last 18 months or so around this green taxonomy. If we can get nuclear included into the green taxonomy, then there's benefits for nuclear, because not only does it allow certain investors to participate now, but it also allows, if you do go for things like debt financing and all that, for you to get a lower cost of debt moving forward. Now, this has advanced significantly over the last 6 months or so. The final bill has been presented and is currently being reviewed, and the expectation is within about 5 to 6 months time or so, it will be approved, and nuclear and natural gas will be included within the EU taxonomy as a green energy source going forward. And that's a big thing moving forward. We also recognize in Europe, there is a lot of shift, especially with this Russia-Ukraine thing. Certain countries are starting to now renew or review their original strategies of shutting down some of their nuclear reactors. Belgium is an example of that. They had a very aggressive shutdown schedule. They're now thinking of actually extending their operating periods for a number of their nuclear fleet. We also know that France recently put out a thing saying they're going to be building 6 new reactors, and then they doubled down on that a couple of weeks later and said, no, it's not 6, there's another 8 coming on top of that. 14 new reactors and coming through in France. We know there's a lot of construction going on in the UK as well. Boris Johnson talks a lot about nuclear power and the support that the government wants to give to the various companies that are going to be installing nuclear power. There's 4 reactors there planned at the moment. We look at the Scandinavian countries, there's a lot of activity going on there with nuclear power. And also the Baltic states, the old East European areas, are also starting to drive forward with their uranium plans as well, or their nuclear plans for power. So Europe has changed a lot in the 2 years. It's a lot more positive from a nuclear perspective, and we're seeing a lot more activity happening on there. US also a big shift over there. We've seen Biden come in, making lots and lots of positive news about nuclear. What the US's strategy is not so much building new nuclear plants, but ensuring that their current fleet, which is the largest fleet in the world, is actually extended. So they're looking at extension of life of assets and all that kind of stuff. A nuclear reactor now can run for 80 years without any problems, and they're looking to extend those moving forward. We also know they're investing a lot in what we call small modular reactors. So these are much cheaper, much simpler units that can be installed at a much lower cost, and multiples of them can be installed to achieve the capacity of a normal, what we would call a light water reactor or something like that. They're also spending money on advanced reactor design. So lots of good stuff going on in the US as well. And of course, China is just huge. I mean, China has said they're going to be building 150 new large reactors by 2035. It is absolutely incredible in terms of how much money and effort they're putting into expanding their nuclear fleet. They will, by I think it's by 2030 be the largest, have the largest nuclear fleet and be the largest consumer of uranium in the world as well. So they're going full, full metal in terms of their construction as well. So from a demand side, we see lots and lots of upside moving forward. We know that last year, the demand for uranium was around 180 million pounds, but primary producers, so those are mines and those types of things, only produced 130 million pounds. So there's a 50 million pound gap at the moment. Where does that 50 million pounds come from? At the moment, it comes from secondary supplies, which include mobile inventories. Those mobile inventories are being depleted. The only way we're going to be able to continue to supply uranium into the market is having new assets come back online again. And all the developers are in the same space. The price that we had a couple of months ago, $45 per pound, was not enough to enable anyone to restart. Now we're getting to the $60 per pound mark. People are starting to talk about restarts and all that kind of stuff. So that's really, really important moving forward as well.
And do you think that this move to zero carbon emissions is also part of that push, especially in China, which have their own challenges with CO2 emissions? Do you think that's also putting a little bit of focus on uranium as an energy source?
There's no doubt that that's one of the fundamental drivers behind where we're going at the moment. When you look at the potential energy sources out there, which are the sources that can actually provide steady 24-hour, 7-day-a-week power supply? It's not renewables, unfortunately. They certainly have their place when you talk about solar and wind and all that, but the sun doesn't shine all the time, the wind doesn't blow all the time. A nuclear reactor operates at about 96% availability within the unit. So they are a very, very steady supply of power. And we see those as being the backbone of the infrastructure moving forward, and then using the renewables to fill in the gaps as you go forward. So it is a very, very significant thing. And I think it's important to note as well is that we talk about wanting to get to zero carbon emissions and how much percentage of our power needs to be provided by nuclear, by renewables, or by hydro or something like that to reach that zero carbon status. But people must also recognize that the amount of power required in the world grows annually by 3% or 4%, depending on what you're looking at. So not only do you have to replace the existing power, but you've also got to keep up with the growth potential as you move forward as well. So there's a huge, huge amount of new builds that I think have to come up in order to be able to meet the future demand of zero carbon energy.
My last question to you before we move on, Keith, is I just want to ask you this. Do you think the sentiment from the general public is starting to change as well? Because that's been a challenge over the years.
It has been a significant challenge. And I do think there has been a fundamental change in the last 12 months to 2 years or so. I think when you read some of the press releases coming out of Europe, where they've been having surveys and all that kind of stuff, I think Europe certainly turned the corner, and certainly not as against nuclear power as they used to be. I think even if you look at somewhere like Belgium and Germany, which are the ones that are shutting down, there's not a huge percentage of people who actually want them shut down. There's probably, it's split 50-50 at the moment in terms of the way they're looking. I think, and that in some way is obviously driven by the price of energy in those countries. With the price is doubled, trebled, whatever it is, and I think that's actually influencing them in some way. But there certainly has been a shift, and I think there's been a generational shift as well. I know when I speak to my kids and all that kind of stuff, my daughters are in their early 20s and all that, nuclear power is nothing that they're concerned about. They don't have this historical concern as we saw with Chernobyl and 3 Mile back in the US and all that kind of stuff, and even to Fukushima to some extent. They recognize that those things have happened, but that doesn't scare them away from nuclear power. They realize the benefits associated with it. So I think there has been a shift in it, and I think there's a generational shift, and I can see that only getting better and better as we move on. Good
to hear. All right, I'll stop interrupting.
Perfect. So I just want to quickly talk about perhaps some of the immediate things that are maybe impacting where the uranium spot price is going. And of course, Sprott is one of the big ones. Sprott started their physical uranium trust back in August of last year. Back then, the price was in their low 30s or so, and we've seen that increase steadily. Sprott are just going into the market and picking up any available spot uranium and basically sequestering that away. Because the really interesting thing with Sprott is even though they're buying up all this uranium, they have no mechanism to sell the uranium. they're almost like a utility in that they're an end user of uranium. So when we look at our demand forecast going forward, historically people were only worried about the utilities because they were the only end users, and anyone else like a trader or something like that or investor would buy and sell it. But now you've got to put Sprott as well also at that end thing, because anything they buy, and they've bought in excess of 20 million pounds, that's gone, that's out of the market. So when we look at our demand forecast, not only do we need to include the utilities, but we've also got to try and guess how much Sprott's going to be buying up as well, because that also is taken out of the market. So really, really important for the uranium price, and they've had a significant impact over the last 6 months or so. We do know with the increases in the spot price coming forward, the utilities, specifically the North American utilities, have started to come back into the market. They're starting to look for term contracts. I mean, obviously, they've got some concerns about what's happening in Ukraine and Russia at the moment. And I think that is in some way driving some of their efforts that they're doing at the moment. They're looking at diversity of supply. They don't want to just rely on Kazakhstan or Eastern Europe for the supply of the uranium. They want to be looking to other areas as well. And hopefully that's going to benefit Lotus. We would be an independent supplier of uranium into that market as well. We also recognize as well that ESG is really, really important. So we talk about environmental, social, and governance as well. And when you talk to a lot of companies now as well, not only do they recognize ESG within themselves as well, but it's also the supply chain. You know, they need to know what their suppliers are doing, what their customers are doing from an ESG perspective. And that's one of the things that Lotus has been pushing for the last 6 months or so, is really trying to build up our ESG profile. We've been working hard on our governance perspective. We've been working hard with our local communities. Really important that we get the support of our local communities so that we have our social license to operate. And of course, we're keeping up with all our environmental activities as well. So we hope from an ESG perspective, we're ticking a number of boxes, and maybe some of the utilities will be looking for a good ESG supply to come into their supply chain as well. It's also really important for us. And then the last one I've already touched on is really to do with the supply and demand and the 2021 numbers of the 50 million pound deficit, which we need to work on. We need to get more producers out there. We need more developers coming on. So just trying to get my slide to work. So I'll go back to the project now. So as we've said, Kayelekera is a low capital, a quick restart, we believe. It has all the required infrastructure currently on site. So we have the capacity to run at about 1.4 million tons per annum, producing 3 million pounds per annum of uranium. Now, there are a number of new processes out there that have come to the front since they shut down the asset in 2014. And I'll talk about a little bit about those just now in terms of how we see those improving the project economics. It's important to note we also have all of our licenses in place. We have our environmental license. We renewed our mining license last year. It's valid for another 15 years. And as I've mentioned already, there is still some expiration upside as well. So the first thing maybe to talk about is just in terms of our timeline of how we see Kayelekera coming back into production. So we've been working hard beginning of this year or end of last year, beginning of this year on our exploration side. As we've just spoken about, we have done a resource upgrade for Kayelekera. We've done some drilling at Livingstonia, which is our tenement down to the south, and we expect to be able to put a resource out there as well. Now, we've started our feasibility study. We started this in August of last year, and we're going to be using the new Kayelekera resource as the base for that feasibility study. But we've been working hard on our plant infrastructure. We've been working hard on our mining studies and all those types of things. And the expectation is we will deliver the feasibility study to the market in the middle of this year. We have had a number of discussions with various offtake companies. We are participating in a number of requests for proposals. But I think what's going to happen is everyone's waiting for us to complete our feasibility study so that they've got a cleaner or clearer line of sight of what our operating costs are going to be, what our production profile is going to be, and what our life of mine is going to be. So we expect to see those offtake negotiations ramp up after the completion of our feasibility. And at the same time, while we're doing offtake, we're going to be looking at financing as well. So as I mentioned, financing, probably for a uranium company, is not that large a deal for us. We're only looking for $50 million for the refurbishment. There will be some costs for some of the improvements we want to do around ore sorting, connecting to the national grid and these other types of things. But again, we're talking 20, maybe $25 million for that kind of stuff. So we're not talking large dollars that we need to raise, and we don't see too many issues with it. Based on the profile or the schedule I'm showing here, We will be in a position by the end of this year, if the uranium price is at a suitable level, to make a final investment decision. And when we make that final investment decision, we've got somewhere between 12 and 15 months to carry out the refurbishment of the plant and to start it back up again. So if we can make that FID at the end of this year, we will be producing, or we will be up and running by Q1 2024 and selling material into the market in the first half of 2024. So I'll just quickly talk about some of these improvements that I've spoken about with regard to how we plan on improving the project. So I just want to start off, when we did our scoping study, which we announced to the market, we made the assumption that the scoping study, or that we would operate the plant in exactly the same way that Paladin did in the scoping study. And the reason why we did that is we wanted to ensure that we could use all of the historical operating data. So all the reagent consumptions, all the throughputs, all the availabilities, all the energy requirements, maintenance costs, and all that kind of stuff we used in the scoping study are real numbers based on an operating plant. So we were very, very comfortable with the numbers that came out of that scoping study. But perhaps more importantly, we used the scoping study to identify what were the main cost drivers and value drivers for the project. What are the things that we can change that will have the biggest impact on the economics of the project? We did that, and we identified 4 areas. One of them is ore sorting. So ore sorting is a technology that's been out there for a while. Started off in the recycling industry and moved in the last 10 years or so into the mining industry. There's been some significant improvements over the last few years on ore sorting, allowing more capacity through the single units and that kind of stuff. What ore sorting does for us, it allows us to increase the grade of the material prior to feeding it into the main plant. So that means instead of having, say, an average of 800 or 900 ppm that we had in our scoping study, we can potentially push that average grade up higher so that we can make sure we hit the 3 million pound per annum production rate steadily throughout the process. That has an impact not only in our production, but also by reducing our operating costs, because we can dilute all of our fixed costs. So really important on that, and we've been very successful with our test work to date. We're in the process of doing our last stage of test work now, but we can effectively, if we wanted to, double the grade of our feed material going into our plant by using ore sorting. So we can take something from 700 to 1400 ppm if we wanted to.
Okay.
The other area we
identified, a couple of minutes left, Keith. Sorry, Keith, we've only got a couple of minutes left, just letting you know.
Yeah, that's fine. I've only got another slide to do after this and we'll be good. The other one is power study. So we know that when the plant was operating, it operated off diesel gen sets, pretty expensive things to run. We're looking at connecting to the national grid, using solar power, and also connecting to, or using the steam off the existing acid plant to generate power. So we think we can halve our power costs by going through this process. And then the last one was just to do with acid recovery. We've got some clever ways of recovering acid and reusing acid back in the process as well. So all of these should allow us to bring down our operating costs below what we had in the scoping study and below what Paladin had when they were operating. I won't talk too much about the exploration because we've already been through that, but really just to finalize then, why do we think Lotus is as well positioned for the next uranium cycle? Well, we're a proven producer. We've produced 3 million pounds per annum, and over the period of time that the plant operated, produced a total of 11 million pounds. In a strong cash position at the moment, we have circa $13 million sitting in our bank account at the moment, which should see us through until the end of the year. We think that we still trade at a discount to our peers, and by that I'm looking back to that slide we spoke about where we are versus the other assets that are on care and maintenance. But I also think that our exploration upside hasn't been valued fully, and I don't think that a number of the technical studies that we're doing that will allow us to drop our C1 costs have been factored into that evaluation as well. Strong board and management team and process with extensive African and uranium experience. We also recently announced the appointment of a new NED as well. Dixie Marshall's come on board as well. So she's going to be fantastic in terms of helping us with our messaging, helping us with our public relations and those types of things. So really looking forward to working with her over the next couple of months in terms of improving our messaging, getting it out there as well. And then some really strong news flow to come, still exploration results to come. There's updates on the feasibility study. There's the feasibility study itself, there's offtake, there's financing, final investment decision. So really, really exciting year for us coming up.
Keith, that was a fantastic presentation. Unfortunately, ladies and gentlemen, I can't answer all your questions, and he has answered quite a few of them in his presentation. Keith, absolutely fabulous presentation, and I agree with you. I think people just need to understand that Lotus is here and it will get back into production. Thanks for joining us at the NWR conference today.
No, thank you very much. That was great.